I own gold because I'm afraid it's going to go to 7,000 or 8,000 or 9,000. And when I say afraid, I really mean that. The circumstance that takes gold to 9,000 US dollars is invariably a very unpleasant circumstance and would devastate other parts of my portfolio and usher in, I think, a much more challenging lifestyle. At my age, I don't want a challenging lifestyle. However, the set of circumstances that surrounds me suggests to me that I need to own gold as an insurance policy against the set of circumstances that would take gold not marginally higher, not to some psychologically important $2,700 number, but some substantially materially important move.
Gold prices are expected to hit another record high this year, despite a dip in physical demand, consultancy Metals Focus said, as interest rate cuts arrive against a backdrop of U.S.-China tensions and conflict in Ukraine and the Middle East. Safe haven demand, driven by geopolitical and economic uncertainty, as well as persistent central bank buying, contributed to a rally in gold from March to May, taking spot prices to a record $2,449.89 per ounce on May 20th. Famed mining investor and market commentator RickRule of Rule Investment Media highlights the impressive performance of gold. In his analysis, RickRule explains that he owns gold as a safeguard against severe economic turmoil that could push its price way higher. He believes such a drastic rise would indicate serious market instability, impacting other investments and lifestyles. This makes gold an essential insurance policy in uncertain times. Examining the recent and long-term trends in the gold market, Rick highlights that gold has skyrocketed from about $250 an ounce in 2000 to nearly $2,400 today, with even higher gains in non-US dollar currencies. He stresses the importance of a long-term view, pointing out that gold has proven its value over the past 2 decades. The latest data from the International Monetary Fund shows that global reserve currencies have reached approximately $12 trillion, while central bank purchases of available gold were estimated at about $3 trillion, according to the Canadian research institution Alpine Macro. With inflation boosting gold prices as a hedge against fiat currency devaluation, this trend drives increased demand and higher prices for gold. Regarding recent movements, Rick observes that the sharp rise in gold prices over the last 2 years contrasts with typical patterns where individual investors drive the increase. Central banks worldwide have been buying gold, leading to record high prices. Consumers and retail investors, particularly in China, are also buying gold as a store of value amid economic and geopolitical uncertainties. Now we present you the clips of RickRule's insights from his recent interview with SOAR Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I hate to dispute your assertion so early in the interview, but I would suggest that the move in gold began to take place in the middle part of the year 2000. Gold is now up from $250 an ounce to verging on 2,400, and in non-US dollar currencies is up substantially more. So I would argue that a longer-term perspective is needed. I will grant you that the rate of increase in the gold price has certainly been more dramatic in the last 2 years. But people who have owned gold for 2 decades, like myself, will note that gold has done its job. And I think the fact that it has done its job in US dollars and more than done its job in foreign currencies over the last 20 years has done as much as anything else to increase activity in gold. Now, the very recent move in gold is unusual in the sense that normally gold price escalation is a consequence of individual investors or retail hoarding. The last 2 years, with the exception of the last 7 weeks, have been marked by retail dishoarding. If you look at the statistics around the ETFs, physical metal ETFs, you will see that for 2 years, retail investors have been selling gold, while at the same time, the central banks have been buying. Whether or not the last 7 or 9 weeks, depending on how you count, have seen whether or not there has been a sea change in retail sentiment is a different question. But I would suggest to you, Kai, that gold and silver are probably just getting started as opposed to how to their moving. My suggestion is that while the retail investors have changed from sellers to net buyers, the net buyers relative to historic norms in gold bull markets are still extremely muted. And the incentives around central bank gold buying, which is to say the poor arithmetic around US Treasury securities and the weaponization of the US dollar, both through the confiscation of Russian assets in US dollars and also the attempts of the US government to apply hegemony on the SWIFT banking system, means that central bank buying continues. If you see retail buying overlaid on top of central bank buying, then I think you see a real move in the gold market. I think I said on your show in January, I don't own gold because I think it might go from 2,400 to 2,750. That doesn't interest me at all. I own gold because I'm afraid it's going to go to 7,000 or 8,000 or 9,000. And when I say afraid, I really mean that. The circumstance that takes gold to 9,000 US dollars is invariably a very unpleasant circumstance and would devastate other parts of my portfolio and usher in, I think, a much more challenging lifestyle. At my age, I don't want a challenging lifestyle. However, the set of circumstances that surrounds me suggests to me that I need to own gold as an insurance policy against the set of circumstances that would take gold not marginally higher, not to some psychologically important $2,700 number, but some substantially materially important move like $7,000 or $8,000 or $9,000.
Regarding the dynamics of precious metals bull markets, RickRule suggests that gold typically initiates the upward trend, driven by fear-based buying, before silver assumes leadership. He mentions the limited market cap of true silver stocks, which amplifies price movements when generalist investors enter the market. The rally in the prices of gold and silver this year highlights the opportunities to leverage the performance through exchange-traded funds investing in gold and silver mining companies. Recent upticks in quality silver juniors hint at a potential breakout in the silver market, underscoring significant market dynamics. SLV is up 37.5% over the past 3 months, but Amplify Prime Junior Silver Miners ETF, which saw a low point at the end of February, is up nearly 60% over the same period. Furthermore, Rick views silver as a speculative asset, allocating a portion of his portfolio to junior silver stocks due to the possibility of extraordinary profits. While he sees potential for significant gains, he warns against over-allocation, particularly for young investors who need balanced portfolios for long-term growth. Let's get back to the interview.
My experience has been that a precious metals bull market is initially led by gold. The first adherents to the narrative, the precious metals narrative, are fear buyers. And so the momentum has to be established by gold. My experience again tells me that once that momentum has been established, perhaps because of the lower unit cost, that silver takes over and begins to move further and faster. Are we far enough along in a gold bull market that silver catches fire? In our last interview, I said it would probably take a year or 18 months. That took place in January. Maybe all things are moving faster now. I don't know. And I don't know why silver outpaces gold, frankly. I've thought an awful lot about that. But I do know, looking at past major markets and small rebound markets, that gold leads the market and then silver takes over leadership. And when silver takes over leadership, it moves further and faster. I know, too, that the combined market cap of the real silver stocks, I don't mean the people that have silver as a component on the name of the company in the share certificate, but rather companies that have some silver. That's the most volatile sector of all. The combined market capitalizations, the silo, if you will, of silver juniors is so constrained that when, as and if, the generalist money comes into the space, as Doug Casey puts it, it's like siphoning Hoover Dam through a garden hose. And we began to see some pretty interesting moves in the higher quality silver juniors in the last 3 months. Is this break up, if you will, break out in silver real? I don't know. I absolutely don't know. I don't particularly care what happens week to week. I really don't. I don't watch the silver price week to week. I just don't. And I'm not interested in trading or psychological support at $30. I own silver because in my experience, when gold really moves, silver really moves. A larger part of my portfolio is denominated in gold, because I'm older. I own it as an insurance asset, but I have been in 4 different markets where silver materially outperformed gold. So I do have a speculative position, more heavily geared to the silver stocks than to silver. I own it not because I think that there's a high probability of profit. I own it because I think there's a possibility of truly extraordinary profit. It wouldn't surprise me that a 2.5 or 3% portfolio position, which is the approximate size of my allocation to junior silver stocks, could, in the 3 to 5 year time frame, constitute 25 to 30% of my overall portfolio. That's why I do that. I'm not saying it's a probability. I'm not saying it's going to occur. I'm saying that based on my past experiences, that there is enough of a possibility of a tenfold increase in a portfolio of high quality silver stocks. And because I can afford the risk, both financially and psychologically, I'm in that place. When I have this discussion with some younger people, what I find out is that they bought the silver narrative so completely that they have 50% of their portfolio in junior silver stocks. And I think that's an insanity, a true insanity. Maybe not if they're officers and directors of small silver mining companies. In other words, if they're investing in themselves. But passive investors, particularly young passive investors, who need fairly balanced portfolios, who need compounding and time on their side, shouldn't overallocate to any speculative asset.
Precious metals continues to be a cornerstone of investment portfolios in 2024. With the global economy presenting new challenges and opportunities, understanding the current trends in gold prices is more important than ever for investors and traders. How do you plan to navigate the opportunities and risks presented by the current trends in the gold and silver markets? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.